One of the questions I get the most from viewers is how are things going to be different in the future, and how should we as investors position our portfolio to handle those differences? What will interest rates be doing? Have we gone into a regime shift where we had a bull market in bonds for 40 years? Are we headed back up with high rates like we had in the 70s and early 80s? How will the government's deficit and debt affect us? And just what are the bigger changes like AI or global conflict or climate change? What will be different 5 or 10 years from now, and what should we do about it today? I think maybe a better question to ask is, what won't change? Are there any timeless truths that successful investors follow that are true today, they were true 50 years ago, and they'll be true 50 years from now? I think there are, and I think, frankly, we ought to focus on those more than trying to predict interest rates or inflation rates or how things might be different a few years from now. And I've come up with 7 that guide my investing approach, and I want to share them with you today. I think they're all important. They're not in any particular order of importance. I follow all of them. I have for almost 30 years of investing, and I hope to and plan to follow them 30 years from now. So let's get right to it. There are 7 of them. I'll show you a number of things on my screen. I'll link to everything I show you below this video. All right, number 1. I think successful investing, the right frame of mind, is long-term. And here I'm thinking not just years, but rather decades. And let me show you something that sort of, I think, highlights this. This is an article, I've seen many articles like this that show us, in this case, they're comparing stocks to 1-month treasury bills. And in this graph, all we really need to focus on is that the blue bars, the blue lines, are when stocks outperformed on an annual basis, and the red lines are when 1-month treasury bills outperformed. In fact, an example of that was just last year, as we can see in this red bar here in 2022. The point here is that if we're looking at it just from an annual basis, there are a lot of times when 1-month treasury bills clobber stocks. It's not uncommon at all. Now, if we zoom out a bit and we look at 5-year periods, well, stocks do better. But as you can see, there are still plenty of times, and by the way, they're grouped together, when treasuries, 1-month treasuries outperformed. You can look at this during the terrible inflation periods of the 70s. That was a rough 5 or 6 years. Of course, you have here the stock market crash of 1929 and as we enter the Great Depression. If we move out to 10 years, it gets better for stocks, but still plenty of red on that chart. We get to 15 years, and still, believe it or not, over a 15-year period, you can have short-term treasuries outperforming stocks. Now, it's not common. They don't outperform by a lot, but still, there's red on that chart. We have to get to 20 years where stocks consistently outperform short-term treasuries. It takes 20 years to get to that period. And if we go out even further, we get to 30 years, you can see stocks do even better. The key takeaway, though, is successful investing is long-term. That has been true, if we go back into the history books. I think it's going to be true tomorrow, no matter what happens. And it reminds me of a Warren Buffett quote. He said, if you aren't willing to own a stock for 10 years, you shouldn't even think about owning it for 10 minutes. And I think that's true with any investment, whether you're talking about a stock or a stock ETF or mutual fund. Successful investing is long-term. All right. Number 2, successful investing is passive. And what I mean by passive is not the debate between passive index funds and actively managed funds, as important as that topic is. But I'm talking about passive in the sense that you're not actively trading. You're not buying in and out. You're not saying, what's the economy going to be like this year? Let me move 50% of my portfolio into a different position to sort of anticipate where interest rates are going to go, or what the Fed is going to do, or what global conflict will look like a year from now. Successful investing is just passive. A lot of time you do absolutely nothing, right? It's don't just do something, stand there. That's the idea. And as one example, there are many studies on this, but this is just one from Berkeley that I'll link to below the video. Trading is hazardous to your wealth, the common stock investment performance of individual investors. Now, they were looking at a period in the 90s, and of course you can read this study for yourself, but as they say here in the abstract, our central message is that trading is hazardous to your wealth. I've hold investments for decades, and I have investments now. I don't ever plan to sell them, right? So I think successful investing is passive. Now, that raises a big question. How do you stay passive? How do you keep investments, through good times and bad? And that actually gets us to some of the other items I have on my list. And we'll start with number 3, diversified. Diversification is critical. And here what I mean is not just, they say don't have all your eggs in one basket. Fair enough. But what I'm talking about is not just being diversified in case one of your investments goes to zero. If you have your investments in, say, mutual funds or ETFs, pretty unlikely that they're going to actually go to zero. But here's the thing with diversification. You can take 2 or more very risky assets, and by risky I simply mean volatile, the prices go up and down a lot, combine them into a portfolio and actually reduce their risk. That was the idea behind Harry Markowitz, who was the father of modern portfolio theory. He said diversification is the only free lunch. You can take risky assets, put them together in a portfolio, and actually reduce the overall risk of the portfolio. That's why in my investment portfolio, I have some U.S. stocks, I have large cap, I have small cap, growth, value. By the way, you can have all of those in a single mutual fund or ETF. Doesn't mean you have to have a bunch of them, or you can have more than one if that's how you want to do that. But then I have international stocks, and some of you might have REITs. And so you have these risky assets, but putting them all together in a diversified portfolio can actually decrease the risk. All right, number 4, low cost. We want to keep costs to an absolute minimum. Many times, you get what you pay for in the world. And so maybe you spend a little bit more on a car and you get a few more bells and whistles. But when it comes to investing, that's just not true. And in fact, study after study after study shows that lower cost investments outperform higher cost investments. I'll give you an example of this. This is from the S&P. This is called a SPIVA report. They look at actively managed funds, and they ask the question, do they outperform their index? So in this case, we're looking at a 15-year time period, and we're looking at this. Look at this. Over 15 years, just over 92% of actively managed funds underperformed the S&P 500. Underperformed. Now, you might say, well, that's fine, Rob. That's the S&P 500. That's large cap U.S. stocks. But I'm sure that the equation tilts in favor of actively managed funds with other types of investments. Well, turns out not really. We can look at, I focus on, remember, long term. By the way, even short term, most funds generally don't outperform. There are some that do. But when you go out to 15 years, 92%, we saw that number. Here's all mid cap, 90% underperformed. Small cap, 89% underperformed. A multi-cap portfolio, 92. We can go down here. We can look at small cap. Large majority underperformed. Even in real estate, underperformed. We can even get into fixed income. And the vast majority of actively managed funds, which are far more expensive than an index fund, underperformed the index. And so it's really stressed the point. We want to keep our fees to an absolute minimum. Think of it this way. We're investing in businesses. Businesses make profit. We want to benefit from as much of that profit as we can. We want to get from their profit to our wallets, right? And we don't want people, with their hands pulling out our profit to pay themselves big fees. So we want to keep our costs as low as possible. All right, number 5, I think it's really important to keep your investments as simple as possible. In the past, I've talked about the 3-fund portfolio. I think that's the starting place. It's certainly not the only reasonable way to invest, and I own more than just 3 funds, but I think it's a good starting point. But no matter what you do, I think we want to keep our portfolio as simple as possible. I have folks email me where some expensive financial advisor has them in 30, 40, 50, 60, sometimes 100 different positions. It's one of the reasons I'm really not a fan of what's called direct indexing, where you pay a fee and they start putting you into literally hundreds of positions. I think it ends up overcomplicating the portfolio unnecessarily. Let me ask you a question. Let's imagine you had hundreds of billions of dollars to invest. All right, You might have more than 10 or even 20 positions, but would you have hundreds? Well, let me show you an example. This is how Warren Buffett invests the money at Berkshire Hathaway. Now, he's investing $350 billion. He only has 48 stocks. And in fact, when you look at values, when you get past the top 10, that represents the lion's share of his portfolio. But even if you look at every single position he has, it's only 48. Now, for you and me, I think that's way, way, way too much, but I'm going to guess you probably don't have $350 billion, that's with a B, billion dollars to invest. I can assure you I don't either. The point, though, is I think keeping our investment portfolios simple is really important. It makes understanding how we're investing much, much easier. It makes rebalancing much, much easier. When you get to retirement, you start pulling your money out, it makes that much, much easier. Successful investors keep their portfolios simple. That's number 5. Number 6, we've got to stay the course. This can be the hard part, right? Because a lot goes on in the world, and it can be very, very difficult to stay the course during difficult times. One of the things Warren Buffett says, the stock market is a device for transferring money from the impatient to the patient. I think that's so true. Here's the thing I always try to keep in mind when it comes to staying the course through difficult times. If we think back just to the 20th century, in the United States, we had what? We had 2 world wars plus a lot of other military conflicts. We had presidents assassinated. We had a president resign in disgrace. We had countless recessions. We had the stock market crash of 1929 that ushered in the Great Depression. We had the flu epidemic that killed countless people. We had the terrible inflation of the 70s. We had the stock market crash of 1987, where in one day the market was down, 22%. It almost sounds like this is just ugly, ugly, ugly. And guess what? During that same time, the Dow rose from 66 to 11,497. Successful investors stay the course. It was true the last 100 years. I think it's going to be true the next 100 years. Again, that's where simple, low cost, diversified, and passive really helps stay the course in my view. All right, the 7th and final timeless truth, and if you've stayed with me this long, I appreciate it. It's this. And this has probably never been more true than it is today, actually. And that is successful investing ignores the pundits and the prognosticators. With social media and the 24/7 news cycle, and you can just get on your iPad or your computer and you can get all the news you could possibly manage, it's easy to get caught up in all of that. People are constantly predicting something, and they're wrong over and over and over again. And then when they're possibly right once, they're there to tell you, see, I told you so. And no one points out that, well, you've kind of been telling us the same thing for 20 years and you finally got it right. You're kind of like a broken clock that's right twice every 24 hours. Not really helpful. And this gets back to our good friend Warren Buffett, who said, we've long felt that the only value of stock forecasters is to make fortune tellers look good. We, by and large, have to ignore the financial news. It's just not helpful. It's not useful. It doesn't help us make sound investment decisions. And it can cause us to violate some of the other principles we've talked about, like, thinking long-term and staying passive and staying the course. So a lot of times, I just don't even listen to the prognosticators. They're just not useful. I don't care what so-and-so's prediction is on interest rates or inflation or the U.S. government's deficit and debt. It doesn't matter to me. It's not going to change how I invest. I think successful investors ignore the pundits and prognosticators. I can tell you this, Warren Buffett isn't listening to them. He's owned Coca-Cola for decades, American Express for decades. They've bought whole businesses that they hold for decades. And that's true whether interest rates are going up, going down, inflation is high, it's low. Basically, just ignore all of the craziness. So there you go. There are sort of what I think are 7 timeless principles that successful investors follow. I can tell you they've helped me stay the course for the past 30 years, and I think they'll help me stay the course, well, if I'm around that long, the next 30 years. Hope you found this helpful. Maybe you have some other timeless principles that you hold dear. If you do, leave them in the comments below. We'd love to hear them. And until next time, remember, the best thing money can buy is financial freedom.